Good morning, good morning. Welcome to another episode of Deal Clinic. I'm Adrian Cormican, and I'm excited for this one today because we have a new guest. Those that have not been to our Deal Clinic before will have noticed it's always been a two-man show, Martyn and myself. Today we're experimenting a little bit and going with a three-man show. So let's see how that pans out. Well, he's not quite a guest. He's been a former boss of mine for the past 8 years, but he's now a business partner. Sorry, been a business partner for the last 8 years, but been my boss previous to that. We're letting Ian Stockdale loose today on the Deal Clinic, explaining to us all the myths around the capital stack. Ian's experience is extensive, and I, for one, have been stopped from doing many a silly thing by him over the years, both socially and professionally. Let's do a little bit of housekeeping while a few more guests log in. Thank you to all of you that joined our webinar in November and asked a question. Some of you asked quite a few questions, which is what we want. There are two ways to ask. You will see in the top right-hand corner, can't remember which way it will be, a single bubble, which is private chat, and only I will see that. And an icon with two bubbles, which is group chat. Choose which way you want to ask a question. They will be monitored throughout, and I'll answer as quickly as possible as appropriate. But rest assured, even if the webinar has ended and we haven't addressed your question, we will collect it and come back to you directly. You'll also see in a few minutes a few icons appear at the bottom of your page. You might need to scroll down a little bit. The first is for those of you that do not receive email communications from us and might have arrived here today, maybe through social media. If you want to hear a little bit more from us and be notified of future events, then please pop your details in below. Our next event in January is called 6 Costly Mistakes to Avoid When Agreeing Real Estate Finance. We've made all the mistakes. Hopefully we can pass them on to you and share those with you so you don't make them. Judging by today's audience, we have here, it's virtually 50-50. 50% that have been previously, so welcome back to all of you. Really appreciate your time once again. And to the new 50%, thank you for joining us, and really do hope that you come again. Our social platform of choice in the social media world is LinkedIn. If you're not following our company page, you will see an option to do so below, and we'd love another follow. Really appreciate it. And remember, please do use those interaction bubbles. I'll be looking for questions. If you don't, I'm fully armed today to put my former boss to the sword with a few difficult questions. That's it for all the housekeeping. Will you please welcome to the stage Martyn Pollock. Morning, Martyn.
Morning, Adrian. Merry Christmas, everyone. Hello, I'm Martyn Pollock, co-founder of Hallcroft. Let's take a bit of a step back. What is the Deal Clinic? So the Deal Clinic is a chance for Adrian, Ian, and myself to add a bit of value, to open up our book of thoughts and tell you what we do on a daily basis. So some of our deal clinics are a deal, some of them are a product, and some break down the capital stack. I'll start with a brief introduction on Hallcroft, our business. Then we'll jump straight into the Deal Clinic, and then we'll have some time for open forum and questions. So Hallcroft, we were founded in 2010. We are a property finance brokerage. We have two sides to our business. The main side of our business is an advisory business where we advise investors and developers on the capital stack. Not just development finance, investment finance, short-term debt, we do the whole bag. The other side to our business, which is really important for today's purposes, is that we run a small unregulated mezzanine finance business, and Ian will be able to tell you more about that. Our team is big and strong. We have a chairman, Raymond Sykes, and we recently brought on a data analyst, James Daniels, who's going to form one of our junior brokers, which we're really excited about. Our product range is full. We have full market knowledge. This slide is something I always focus on all of our deal clinics, because often some people forget we have such a wide range of products. In fact, I'd love Ian to join us to talk about student accommodation and retirement living, because he's such an expert in those things. But surely we are experts in development finance. It makes up more than half of our book, but we do cover the whole market. So on to the deal clinic. I'm going to do my best Terry Wogan act, and I'll be asking Ian a number of questions to try and weasel out what we can in relation to the myths of the capital stack. We're going to be unapologetic today to focus on mezzanine finance, but we feel that that's actually where we can add a lot of value, and we can add value by way of being investors, advisors and developers in relation to mezzanine finance. So without further ado, let's get started on the questions. Over to Ian. Ian, what is mezzanine finance?
Good morning, everyone. Many thanks for the introduction, Martyn and Adrian, for those, I think, kind words we mentioned earlier. So, mezzanine finance is an additional form of finance which complements senior debt from banks and funds and the developer's own equity. The mezzanine finance is generally secured on a second charge behind the senior lender. The cost varies depending on the size of the loan. For more moderate loans, the interest rate is generally in the range of 20 to 24%, up to loan to value around 70%. And in addition, there are arrangement fees, exit fees, and professional fees to consider. The blended interest rate, which if you look at a combination of the senior loan and the mezzanine loan compared to stretch senior, where you borrow a higher amount from a single lender, between the two, there should be broadly similar blended interest rates. And thinking about how much of the costs of a scheme can be funded, a combination of a senior loan and a mezzanine loan should generally take you in the loan to cost range to around 85 to 90%. And that series of bar charts tries to compare, or it does compare. If you look at the first one, that's a conventional senior loan at loan to value, say 60%, which is 77% loan to cost. Therefore, the developer needs to provide approximately 23% of the cost. The middle one is including mezzanine, and the end one looks at senior, stretch senior. So we'll come on to those in a bit more detail in a little while.
And that's all very clear. It is quite technical, and I'm sure a lot of the people watching this are experts in their own right, whether developers or in property finance. But more generally, why would you use mezzanine finance? And what would you say the benefits of mezzanine finance are? And let's just keep this to a borrower side for the time being.
Sure. Okay. So for the developer, the benefit of using mezzanine finance is it complements the available equity that you have and allows you to either fund more schemes or bigger schemes. So potentially both. And that allows the developer to spread their risk perhaps across a number of schemes. And because of how the product works, as you're investing less equity, providing you get a good outcome with the project, then the developer's return on equity should be higher with mezzanine than using the whole of their own equity.
And can I throw a curveball at you?
You can.
This is not on the list of questions you wanted me to ask you. Same question as a mezzanine investor. Why would you want to be a mezzanine investor, and what's the benefits of being a mezzanine investor?
Okay, so the answer there lies in the balance of risk and return. So with interest rates and returns on a range of financial products very low, and by example, stock market dividend yield around 3-4%. As an investor in a mezzanine loan, you can get a significantly higher return, but you need to understand the risk you're taking. And the way to, amongst the ways of making that a risk that's acceptable to take is a level of due diligence that's undertaken by the lender on the borrower and the project. And there's a lot of information around which will allow you to, as a lender, to assess both the project and the developer. So with lots of thorough diligence, then a good lending decision can be made, and the returns are very, very attractive. But you need to be in a position to balance your investment portfolio. So only a certain portion in a product of this nature. And you also need to be very patient, because it's not unusual for projects to run on longer than the original timetable, and you need to be ready to extend the loan if that's necessary, so that there are no issues with an extension. Therefore, the developers got the confidence that they can manage the project as appropriate without any concerns about extending the finance that supports the project.
Very interesting, very interesting. Thanks for that. Moving on to our capital stack and a comparison between mezzanine finance at 70% and stretch senior debt at 70%. Can you talk us through this slide, and I'll maybe come in and comment in relation to senior debt once you've given us an idea of this capital stack.
Okay, so thanks for that, Martyn. So this table illustrates a deal we're working on at the moment, and it shows this is live pricing based on an exact a deal that we're currently negotiating on behalf of a client. And what I'm trying to show in this table is hence the title of the webinar, Myths of the Capital Stack. If you don't do the detailed analysis and understand how mezzanine and senior loans are structured differently, you might assume that the same loan to value as between senior plus a mezzanine loan at, say, 70% loan to value and a stretch senior loan at 70% loan to value would have both the same equity, broadly the same equity, and the same profit returns. But generally they don't. And that's because the interest methodology is different. Whereas a senior loan, interest is deducted from the facility. With mezzanine, generally the interest is added to the facility at the end, and therefore the loan to value on a mezzanine loan is slightly higher. And if you follow through, look at the blue boxes, the blue highlights. On this capital stack, which is the exact same project, 3 houses in South London, the cost to fund are lower with mezzanine and higher with stretch senior because of how interest is treated, which means the developer equity is lower with the mezzanine and higher with stretch senior, but the profit is slightly lower because mezzanine in this example is slightly more expensive. So I hope that was clear.
So the mezzanine is on the left-hand side and senior debt's on the right-hand side.
Yes.
And so do you then mean that from this table that senior debt finance would be 70% loan to value gross and mezzanine finance loan to GDV would be 70% net?
Correct.
Net of interest. That's interesting, really interesting.
Yeah, so if you added the forecast interest to the mezzanine capital, then the mezzanine loan to value would generally be in the range of about 73 to 75%, depending on the interest rate, the loan term, and so on. And this nuance is really important. If capital is your main constraint, because if you've only got a certain amount of money, then you have only a certain amount of money, then potentially the combination of senior plus mezz would be more available to you than a stretch senior loan.
Or if your target was return on equity, again, this would be the model to follow. I mean, from my side, the last deal clinic we did was whether 70% loan to GDV was achievable in the senior debt market. I don't think it is realistically achievable for most of the market. And that's after speaking to the challenger banks, the investment funds. We have done a market-wide analysis of where 70% loan to GDV sits. In fact, there's some people advertising 75% loan to GDV, and that seems to be more of the equity fund side of things. Certainly, there are challenger banks come to the market saying they'll do 70%. That 70% is really targeted at mid-market, not affordable, mid-market product. And actually, the guys that can probably achieve that, the borrowers that can really achieve that are probably AAA star developers who have demonstrated they can build well, they can buy well, build well, and sell well. And they've probably demonstrated they can do a turn of the wheel maybe 10, maybe 15 times. They probably were 70% loan to GDV 5 years ago. Nothing's changed for them. Is somebody coming to the market that's not mid-market product, that maybe doesn't have the best of track record, the completely clean slate, is he got the ability to raise 70%? I don't think so. And so therefore, Ian, do you think that it's a more achievable way of getting to 70%?
I think that generally is true. And also what would be a greater contrast down the figures in that capital stack is some of the lenders that you're referring to, Martyn, who would do 70%. My expectation is their pricing will be somewhat higher than that 7.85%. That's a direct that's indicative terms from a well-established bank senior lender, and a fund is, because they're arguably taking more risk, would be looking for perhaps a somewhat higher interest rate. And if so, then that would exaggerate the differences in the equity requirement between stretch senior and the mezz combination, and potentially would change or remove the profit difference as well.
It's really interesting. It's fascinating, actually. So on summary on that slide, we can maybe say that to a large extent, you can put less money in using mezzanine at 70% versus senior. Your return on equity will be higher, and
Correct.
There's maybe a little bit of. I'm sure some of the challenger banks would like to challenge us on this point, but we feel the blended price of mezzanine is very comparable to senior, maybe even better.
Correct.
Fine. Okay, good one. What are the risks of mezzanine finance? Are there any points to note? It sounds great, we're really selling it, but surely to goodness there's got to be something. There's got to be a sting in the tail.
Well, that's a very fair question. So more points of detail is think about the additional fees, because there will be normally legals for the mezzanine lender, potentially valuation fee and some monitoring fees, which that they need to be. They are built into that calculation I've got on the screen now, but you do need to be aware of that. Is the interest rate simple or capitalised? So that makes quite a difference with the headline rate and the actual rate when you take account of monthly or a period of capitalisation may be slightly different. And then where the sting in the tail that you referred to, Martyn, there is the risk that the project doesn't run to plan. If you get a delay, a material delay, and if you struggle to sell, then because you're carrying a higher level of debt and at higher interest rates, then there will be profit erosion to be concerned about. And also think about what do you know about the mezzanine lender. We've got quite a few war stories we could talk through offline, we put it like that, about how lenders react when projects don't run to plan. And it's really important to understand that particular aspect when you make the choice of mezzanine lender.
I'm biting my tongue here, Ian, on the risks and those war stories, like you say, for another day. And we do display some of them online occasionally, but do your due diligence on your mezzanine lender would be a highlight of mine.
Same question. So the risk to mezzanine finance to a borrower, clearly they've got to understand the lender. Understanding the interest, simple or capitalised, is really interesting because that can vary massively. Risk of delays is a massive problem, and surely if you're a developer borrower using mezzanine finance, if it's going to be a new style of product you're bringing to market and there's risks involved in that, maybe you don't understand your timelines entirely, maybe it's not for you. But what about becoming a mezzanine investor? What are the risks from that side?
I think that the main point there is going to reverse what we just said about the developer, is that you need to be ready to extend the loan. From my experience, probably something like half the loans that we've seen have run beyond the original timetable, mostly by a moderate amount, and that's fine. We've seen one loan for a whole variety of reasons run for shall we say, twice as long as originally planned. It was a very unexpected and very complicated circumstance, and you need to know that. And this is my opinion, okay? I might better put that caveat on because other lenders may have a different view. But you need to be comfortable that if it's the right decision for the project and the developer, then you should be ready to extend. And to do that, you need to be aware that your investment in the mezzanine loan should be part of your assets, and that you're not putting yourself under financial pressure by taking a position in the mezzanine loan.
And I'll add on to that, Ian, as well. And this is something that you have saved me on many times. It's the importance of who the senior lender is.
Yeah.
So we, as a mezzanine lending platform, you can be as patient as you want. But if you've got a senior lender that won't be patient in front of you, as a second charge mortgagee, you have no hope. And we've seen some transactions over the years which have been turned down because the senior lender isn't of the right ilk. And that, especially during the COVID times, has saved us hugely.
Great. Thank you, Martyn.
How would you decide whether to use mezzanine finance or not? What are the key considerations you would bring to the table for a borrower on the borrower side and a developer side? What should they be considering?
I would highlight 2 points there. One is who is the mezzanine lender, and that combines with the point Aidan just made with who are you intended to choose as your senior lender. And then secondly, equally important is what's your confidence in the delivery of the project you're about to start, and if you're well prepared, you're ready to build, and you're expecting to sell into a strong sales market, then the choice of mezzanine could be a pretty sound decision.
Loud and clear. I've got a question that we've not really discussed. Again, I want to throw a curveball at both of you. Is there a circumstance where if you take a senior debt from a senior debt provider and you take a mezzanine loan from a mezzanine provider, and the mezzanine is 18% per annum or 20% per annum, and the senior debt is 6 or 7% per annum, if you complete a development and you want to sell your units, can you repay the expensive debt first, or do you have to hold that?
The answer to that depends on the position of the senior lender, but it is a reasonable working assumption that a senior lender, particularly a specialist development finance lender, will allow proceeds to be released from sales once they've started to de-gear. So let's say they start at a loan to value 60%, a couple of sales come through and they're below, then by then let's say below 50%, then from that point perhaps 25% released to repay mezzanine, 75 to repay the senior. That's a fair working assumption, and the benefit then, of course, is that it improves the profitability of the project because you're replacing more expensive debt with lower cost senior debt.
And other than picking up the phone to me, yourself or Adrian, how would a borrower go about doing that? How would they manage that process with a senior lender and a mezzanine lender? Seems quite complicated to me. How do you convince them to do that?
So generally the project will be built, so no construction risk remaining before this request could really be heard. It could maybe be made sooner, but once everything's built, then you're in a position to make that request. And then the way I would approach that is build a cash flow which shows how the loan would repay, model a release on each sale with a reasonable position, so that by the time that the project is down to the last 1 or 2 units, the lender is at a moderate loan to value, say, depending on the lender, 30-40%.
Sounds like a good strategy to me.
Just a couple of questions that have come in from some of the attendees that would be great to run through. Ian, could you run through the difference in interest treatment for senior and mezz? This seems really important.
Right, okay. So with a senior loan, on a loan to value structure, so I need to emphasize that because a loan to cost structure doesn't work in the same way, but most development finance is structured on loan to value. So let's say the asset is worth, or the property is worth 1 million, a loan, 60% of that, 600,000. The interest for the loan period is calculated, and then that allowance is deducted from the available facility. With a mezzanine loan, generally, not all lenders do this, but generally, an agreed loan to value is set, so let's say 70%, then the interest which accrues over the term of the loan is added to the capital to create a redemption figure at maturity. And with a loan opening at 70% loan to value, depending on how long the loan runs for, the interest will add 3 to 5% of to the capital, and therefore the mezzanine loan at its maturity will be in the range of 75% loan to value. And that's what creates this difference between the equity requirement between these two illustrations that is now on the screen.
Brilliant. A couple more here that have come in that we'll finish off with. Someone's saying they're slow this morning. They're obviously winding down for Christmas. I'm slow this morning in terms of the mezz interest. Can you explain that? I think we've just explained that, but he's asking about the capital stack. I think we'll take that offline. We've already gone through it, but if you need a little bit more explanation, rather than go back through the capital stack again, quite happy to share this information with everyone that's on here. I will apologise as well at the start. I explained that I would drop in, I'll subscribe to the next newsletter and LinkedIn, and I completely forgot. I was listening away to Ian, and I forgot to launch those. So they are at the bottom now. A couple of other things. Don't most banks now offer 65% loan to value, and UTB offers 70% with the RLS scheme. Yeah, any comments on that? 65% is generally available in the market, Martyn, isn't it?
Yeah, for me, there's a lot of clamour. There's a lot of liquidity in the market. There's new senior debt players coming to the market all the time. 70% is clearly something that senior debt providers want to talk about. Previously, they weren't talking about it. It would be offered to their private clients or their best clients, their best borrowers. Now they have more appetite to put that into the market. My point is that I believe that 70% is only restricted to certain pool of developers, certain pool of product. And actually, I don't think most of the deals we see are fit for that. And I think that's where mezzanine comes in to really make that difference, in addition to the price and in addition to your rate of return.
And Adrian, if I could add to that, that the cost of the top slice of a senior at 65 or 70%, it can be quite expensive. And by working through the maths to find out what you're actually paying for that top slice, you can then do a comparison. Is that more beneficial than looking at maybe a slightly lower senior loan and a mezzanine loan, and just literally work through the maths and find out which combination works? Yeah. I think it's fair to say that the top slice on higher loan to value bank and fund loans has come down somewhat recently. Going back 2 or 3, well, let's say 5 years, that top slice was something like 35% interest rate. Competition brought that down.
Really good point, and that's what's come through on this webinar today, is make sure that you actually do the maths, because it's easy just to get drawn in and look at loan to values, price, and think that you've got a great price, but actually get your Excel spreadsheet out and actually make sure that you decide and you know exactly what you're paying for. One last question here. Equity requirements, general comments. So banks are making noises about doing 70 to 75% loan to GDV, as we've touched on, and whether that's there or not is still debatable. But what is the equity requirements when you are taking a mezz top up?
Okay, I guess that almost it comes back to the previous point. It depends on the maths, and as a general point, which is back to our theme of the myth of the capital stack, the same nominal loan to value should require less equity if it's a senior mezz combination compared to a higher loan to value bank loan.
The specific question, which I didn't call out, was: is 7% of cost acceptable from an equity from a developer? Which I think is a bit of a leading question. It's we've seen it. We've definitely seen that happen. It depends. Again, it goes back to what Ian said there. It's do the maths. And lenders will allow that to happen, because the general feel for it is around 10% of cost is what they want to see, that hurt money in. They want to see that they've put some money in themselves rather than it all being debt. But 10% is a general rule of thumb. But we've seen things we've seen matters happen as low as 6%. But of course, there's a little bit of massaging and conversations to be had around that.
Adrian, I think to a large extent, the 10% loan to cost from a developer, challenger banks, they are fixated by that. Investment funds, the larger ones, are probably have that requirement as well. But when you drip feed down, there's a plethora of market players who will accept less skin in the game. God, is even 100% funding. It's not something that we do a lot of, but there's a solution for everyone.
I'm going to squeeze one more in. We're just touching 30 minutes, so we're going to finish up on this one. If a project runs on, presumably mezz interest keeps running at 20%, reducing profitability. Ian, you touched on that a little bit earlier, but let's make one last comment and leave it there on that one.
Well, that of course, that is correct. When you've got a debt product, then if the project runs along and the debt is not repaid, then the interest will run against you, and that is one of the risks of taking mezzanine finance or high loan to value finance in any form. So I'd say yes is the answer to that question, again.
Yeah, one word that I use is just have respect for the products you're taking, because you're not respecting a product if you are modelling your scheme to be finished in 12 months and sold within 6. And the reality is, it's going to take longer. It's going to cost you more because you're going to run over, and you're not having respect for the product that you're building in. So, like Ian said, yeah, it's something we see, but make sure that you model out correctly so that you're not making those mistakes as you go along. Brilliant. You've done a great job. Terry Wogan, at his best. Brilliant. Ian, thank you very much for joining us for the first time. We want to see you more. Like Martyn said, student retirement living. That's what we can do next on this. Merry Christmas for myself.
Merry Christmas from me as well.
Merry Christmas, everyone.
Thanks for joining us. Take care.
Take care.